$3 million bucks. It's a lot.
It is a lot. And I think this is where we definitely had a lot of lessons learned on the equity side of things.
How do you do that?
You know what? We saw other people doing it, and we were always scared of leaving the city.
Right, we would reach out to a couple lenders and had some good relationships with local lenders. At some point, that kind of flipped for us. We now work with brokers, scheduling, scope sheets, and essentially just making sure that everybody's contracts were robust, and it's not just you're signing a piece of paper or an estimate. If we build it, hold it, and operate it, that's the dream right there.
Hey everybody, Enis here, Whiteacre Properties. Welcome back to another episode. Today we got a meetup interview. If you guys haven't been to our meetup events, please come join us. It's once a month here in Natick, and you get to talk to other local investors, and it's all about collaboration. It's about doing deals together. It's about really getting inspired from each other, but also from our guest speakers. Our guest speaker today is Dan and Ray. These are good friends of mine, and these guys have been around in the greater Boston market for 14 years now. And they're gonna come and share with us all the information about purchase price and construction numbers, and really the struggles with the project from the leasing to the construction to now the property management. So stay tuned for the interview, and most importantly, come join me at the meetup events. It's Boston Real Estate Connection meetup. We'll put the link below, and really looking forward to seeing you guys there. For anyone that doesn't know you guys, anybody that's not going to be at the meetup tonight that hasn't met you, quick introduction, 30 seconds.
Dan Rubin, Ray Hurteau. We are RH Investment Group. We are a multifamily developer, builder, owner, operator in greater Boston. Been doing it since 2010. We've done a bunch of for sale development. We also have a rental portfolio, and
Yeah, went full-time, started in 2010 and went full-time 2015, 2016. Yeah. So we did a lot of smaller developments, and now as we've been growing, our focus is on larger multifamily developments, like 12 to 50 units. Just finished a 30-unit build in Lynn.
Well, that's awesome. But you guys started obviously with much smaller projects, right? Because we've known each other for a while. You started with like single families and then jumped into condo conversion, or do I have that wrong?
So we've only done one single family for the entire the entire business's duration. But started out, I bought my first triple decker 2008 at the bottom of the market. Kind of did like a house hack type situation where I lived in one unit, rented the others out, had a roommate. And then 2010, Ray and I bought our first 3-family condo conversion project in Dorchester, which we did.
And you did a ton of those, right? Dorchester and Somerville.
Yeah, most of our
South Boston.
Yeah,
right?
for a good number of years, we concentrated in Dorchester, South Boston, did a couple projects in Somerville, did a project in Brookline, but that we tried to stay in the Boston market.
So what I want to focus tonight is obviously the Lynn development, right? So you guys obviously took a 180 turn and went from the smaller multifamily and condo conversions to these developments, which I'm super interested because we're trying to pivot into that, right? So I'm a little selfish here. I wanted to learn the why, the mindset behind it. But, and we have obviously talked a little bit about this, but why not stick with what you know, right? You guys got a good formula for finding those properties, know what to do with it. Design was beautiful. So why kind of pivot into multifamily development?
The easiest answer is scale. So you're going to end up spending almost the exact same amount of time from start to finish on a project. And from our perspective, if you're going to invest 2 years of your life on a building, we should try and see if we can do more at scale. It's not like these bigger buildings take 5 years to build and develop and there's a longer runway. So that was the main reason. The second reason was just to do something a little bigger and outside of our comfort zone, because we felt like what happened was the genesis of all of this was COVID.
Yeah.
It struck, we were in the middle of some projects. We were weeks away on a CO at a project, and then that had to sit for 6 months, and the world came to a standstill at that point.
Right.
And during that time frame, Dan and I spoke a lot and essentially said, what are we doing and where do we want to go? So in a way, COVID was good that it allowed us to do some self-reflection.
Yeah, and I think the business model from the beginning was that we wanted to ultimately grow a rental portfolio. And what ended up happening was we kind of got into this hamster wheel situation where when Ray and I quit our corporate W-2 jobs in 2015, we needed money to survive. So we needed to ramp up the for sale development, the condo development. And the problem with that was building the rental portfolio took a back seat. And so it was hard to continue to grow. And obviously market conditions, where we are, prices have gone up significantly, and trying to find a rental project that penciled, or a smaller rental project that penciled, just didn't make sense. So we started continuing to do the for sale development. And so, we continuously felt like we had to feed the beast and keep buying and selling just to make a living. And the problem is we didn't really have much left over. Like, we were like, oh, we'll do the condo projects and we'll pay for buying more rentals.
It was like a third to us, a third to each of us, and then a third to our savings.
Yeah, and we quickly realized that, like, after taxes and after all this stuff, there really wasn't much left, and we would have to be saving for a long time to be able to start acquiring more rentals. So,
or even doing bigger development projects.
Correct.
But, again, those bigger development projects take on a whole different life of their own, because now you have a warranty period. So even though you've sold it, you're still engaged in the building and have that side of it. So we kind of flipped the switch and said, if we can do it at scale, and it was also due to discussions about syndication, just in general. We were talking about that before the interview. Just, should we do syndications? Is that where we want to be? And knowing that you can have more value with the more number of units. So I think that was a strategic decision.
We had acquired a number of rentals, like, ad hoc throughout the years.
Randomly, no plan, but
right. I mean, and they were working, they were cash flowing, they're doing well, but, like, it wasn't scalable. And so, to Ray's point, COVID hit. We had a number of projects going. We got kind of screwed on because we couldn't sell them and we couldn't finish them. And so Ray and I kind of reevaluated what our long-term goals were, and we said, you know what, like, I think, and we saw other people doing it, and we were always scared of leaving the city.
Yeah,
that was kind of like our security blanket, right? We knew the city, we knew the micro markets, we knew which streets were good and which streets were bad, but then we saw, especially when COVID happened, a lot of people left the city, and we saw all of these suburban markets explode, and everyone was leaving the city to go to the suburbs. And we saw a lot of developers and builders doing a lot of larger projects outside the city. And we said, you know what, maybe leaving our comfort zone isn't as bad of an idea as we originally thought. We thought that the city was never that was recession proof, and there was such a diverse industry in the city where, if one market took a hit, then the other markets would prop it up. But then COVID happened and everybody shut down. Everything shut down and everybody left.
There were a few other things, not to drag this answer out any longer, but we ended up meeting somebody who's kind of like our unofficial mentor, working in the same space, actually a bigger player. And his advice was, you don't necessarily have a product or project problem, you have a location problem. Because the second part of that was, to Dan's point, we're always in Boston. Well, it's no surprise and no mystery that Boston is extremely difficult to get anything approved in. And once you do get it approved, it's an even longer process just to get your permit. The approval's half the battle, and then just getting everything entitled and all the paperwork is the
logistically and everything is just more.
Right, exactly. So we kind of looked at those two things. And then the third part was, anybody can jump in and buy a 3-family. You can get FHA financing for it. So there's a lot of competition from retail investors, as we'll call it. And not to belittle that group, that's a very important group of people, a lot of mom and pops, but not as many people can jump into a 20 or 30 unit build. So since we have that construction build and the management build, an excellent merging of the two in build and operate, because if you buy something that somebody else built, you don't really know what's behind the walls. But if we build it, hold it, and operate it, that's the dream right there.
Yeah.
So everything sort of fell into place, and that's how we ended.
And that's when we started exploring markets outside of the city and larger projects.
Gotcha. So now, obviously, I'm definitely want to jump into Lynn and get your feedback on the city itself, the experience with the project. But how difficult was to not look at those condo projects anymore, right? Because it took like, what, 2+ years of just focused on this one building. And I don't know if you did anything else in the meantime, but you guys were known for doing condo projects. I'm sure agents reached out, leads were coming to you, but you were disciplined to say, you know what, no, this is what we're going to do moving forward. So is that still the case? And
yeah,
because that's the toughest part when you do one thing really good and you're known for that, to say, you know what, I'm done with this, I'm going to go here.
Right.
Like, how do you do that?
Just flip a switch. Yeah. You just wake up one day and you say, this is what we're looking at now. These are the deals I'm looking at. And that's what we would tell any agents that reached out. We said, we're actually not exploring those anymore. We're looking to get into this. So if you have anything, let us know.
And we started reaching out to new agents too, because obviously the agents that we had dealt with are more residential agents. They're not more commercially focused. So we started working with or reaching out to some of the larger folks like Marcus and Millichap and some of the larger players that kind of handle the larger multifamily, either new development, existing value add, land, stuff like that.
So let's talk about the project itself. How do you underwrite something like a 30 unit in Lynn where you guys haven't developed a 30 unit before? How does it work?
Putting the numbers into the spreadsheet, we knew what our build costs were for condo.
Okay.
And so we would just go line by line. It's almost the exercise of evaluate one and do it soup to nuts, even if you're not going to move forward with it. So you at least have a baseline of what your costs will be. You're not going to be spending $10 or $20 a square foot on tile. Where you can cut down on finishes. 90% of the building is the cost, right? Infrastructure, the framing, everything that goes behind the walls has to be essentially the same. You might cut down the number of bathrooms or the number of fixtures or locations might be more stacked, if you will, from floor to floor. But you essentially say, here's what we think the numbers will be. Again, we had a mentor kind of bounce some ideas off of him. And they look at it in terms of cost per unit as well as cost per foot. So there's sort of two ways to do a sanity check. And then I just said, just add 10%, right, for the unknown and for... it sounds crazy, you take that baseline number, but add 10%, just so you can say, if anything pops up that I wasn't expecting, or because it's commercial and you'll need something like a booster pump if there's low water pressure at the street, those kinds of things, you're accounting for it.
Yeah, so the majority, to Ray's point, I would say 90% of a larger build on, I would say, a non-high-rise construction project, right? So like not all steel, nothing over 70 feet. 90% of what you put in a triple decker or a 3-family versus what you put in a 6-story building it's all the same. There's a few obviously caveats like elevators and steel, like a podium, transformers for like electrical and all that stuff. But the majority of the stuff is the same. So it's kind of just expanding on that and multiplying that out by how much square footage or how many units based on the spreadsheet. And then obviously we reached out to folks that had experience in larger projects and said, hey, what are you building a podium build for these days? And like to Ray's point, we got the numbers back on like dollar per gross square foot and or dollar per unit. Most guys at that scale like to do it on a dollar per unit basis, because if you do it on a gross square footage, there could be a lot of square footage in some of these larger buildings because of amenity space and hallways and things like commercial units, lobbies, all that stuff. So that's why the dollar per unit number is a little bit more realistic than the dollar per foot sometimes.
Gotcha. Would any of you guys, if you don't mind going over rough numbers?
That's right.
Construction,
Oh boy,
and you can say cost per unit or, but just to give people watching an idea of what are we talking about, right? We might have some people local to Boston,
sure, or
they might be in the North Shore, but this is a project in Lynn. Take it away.
I would say, I would say price per foot cost, whether it's, regardless of, I think, where you are in Eastern Massachusetts, it's going to be the same, right? More or less.
Pretty much, yeah. I mean, mileage will vary. The fact that I think the entire eastern side of Massachusetts and even southern New Hampshire, you might find some ways to get better pricing. But when you're working on a building that has more units, you're working under construction control, and unions may or may not be a factor. It depends on the municipality. So our numbers are not hard and fast numbers. I think it's the point that we're all trying to make here is So where we fell in was the total cost of construction was about 8 million, I think is what we had budgeted.
Hard cost.
Roughly. And that included our contingency. There were obviously costs for the architect and the engineers and debt service and all that sort of thing, like an interest reserve for the lender. So that's outside of that 8 million. And we actually came in right around that number.
That's awesome.
Yeah. And that number was initially exclusive of the commercial space, but now it's inclusive of the commercial space. We were fortunate enough to get a tenant finally, because commercial is difficult, but we have a ground floor level with great street access. That tenant is pretty much splitting the cost with us. So we were able to kind of
the build
advantage,
Gotcha.
Yeah.
That's great.
That was a good advantage and a good win for everybody. I don't have all the numbers in my head, but what I will say is that it was probably in the high twos per foot. I mean, again, it's like gross per foot, all in per foot. We're
Call it around 300.
at the end of the day, what you're really looking at is total development cost, right? And total development cost is the total cost of acquisition, financing, soft costs, hard costs,
all in.
And we were somewhere probably around like 333 a foot, somewhere in that range. That number is in my head for some reason, and that's based on gross square footage.
Gotcha.
So that's the number, and I think it comes out to like high twos per unit.
Yeah.
So again, folks at home can check, and I
Right.
can grab the calculator. I can grab the phone if needed and double check it. But
that's
Go get the spreadsheet.
But essentially, the good news was, projects typically have an overage, and that was why we kind of put the 10% extra in there, because we ended up using almost all of it, but we didn't go over that amount. And that was the most important part.
So the 10% was a good idea.
Correct. And we brought on a project consultant as well. So we had a line item for project management, and we had a consultant specialist. He was like a utility knife, right? Jack of all trades. And he really helped us out with the bidding, because we hadn't done that before. And those are the things that we learned. Scheduling, scope sheets, and essentially just making sure that everybody's contracts were robust. And it's not just you're signing a piece of paper, an estimate.
Gotcha.
Way more formal than that, especially if submittals are involved. So
Gotcha.
That helped keep the costs under control. So get lots of bids.
Remind me again, what did you guys buy the property for?
1.15.
And this was a vacant bank, right? If I remember.
No, it was an old bank, but it was being used. It was owned by an insurance agency, and they were just using it as kind of a satellite. Their main office was in Boston, and they were using it as a satellite office for kind of back office administrative. They were storing a lot of like their documents and stuff. Okay. So it was being used as just a commercial building.
So people that are watching probably, a project like this one where the capital, so it's, we're talking about really high numbers compared to somebody doing flips or condo developments, right? What does the capital raise look like? We talked about syndication earlier, but how did you guys handle it? What did you learn from it? If there's any lessons learned there?
Definitely. In order to raise, so we always raise capital, internally, right, on the equity part. So of that total development cost that you have to model out ahead of time, we used to work individually with lenders, right? We would reach out to a couple lenders and had some good relationships with local lenders. Mm-hmm. At some point, that kind of flipped for us, and that was another sort of lesson learned. We now work with brokers. So just as you have a broker for selling your property, you can get a broker to help acquire your debt and or equity. Mm-hmm. So for this project, we brought the equity through us and our investors, and that was to the tune of about $3 million. Mm-hmm. And they brought the debt, which was 7.3. So it was a 70% loan to cost split, essentially, on a total development of about 10.5.
Okay.
Yeah. And then as far as you were saying, how we approached raising the capital.
Because 3 million, again, a lot of people be like, I want to do something like that, right? So what are the moving parts? So you can go to the bank or to a broker. They'll be like, all right, what is your 30% equity? $3 million, it's a lot.
It is a lot. And I think this is where we definitely had a lot of lessons learned on the equity side of things. We obviously the goal was 3 million. Ray and I as GP, what was our initial
general partner, limited partner?
No, what was our initial?
Our initial estimate is GP
for us.
Yeah, the typical model is the GP brings 10% of the equity, and the limited partners will bring 90%, and ended up being more 50-50 on this one. It was right during the time when the Fed was starting to raise rates, right? 21, end of 21, early 22. So we were lucky enough to get some debt terms before rates went berserk. And then second of all, we were lucky enough to get investors that, agreed to our terms, which were actually probably a little more competitive than what the market was offering. But in the future, as part of the lesson learned in underwriting, we do want to probably have our brokers get the debt and the equity, or at least a chunk of the equity, if we can't do the full raise, or it doesn't make sense for us to spend time doing that raise.
I think the good news of it was that Ray and I own 100% of the building. So I think a lot of the folks that we had spoken to on the equity side, if you're looking to raise that much, a lot of people are going to look for a piece of the ownership of the building, and so we were able to retain that, which was a good thing. Obviously, we weren't able to raise a lot, so Ray and I had to contribute a good chunk. And to Ray's point, we were able to get pretty favorable terms because we went out to our existing investor pool to raise the capital, and obviously that was exhausted pretty quickly.
Because the amount we would raise on a 3-family is a couple $100,000. Right. So, we're like, we'll just pool all the investors together. And that did get us a big amount, but it wasn't as big as we were.
And then what we also learned was, a typical project or typical investors on a larger multifamily deal, their returns look a lot different than what we were looking to give our investors.
Well, this was also a unique situation. The building's located in an opportunity zone, so our idea was a 10-year hold, and we would recapitalize the debt based on year 3 cash flows. So the investors would get taken care of, everybody repaid, and then we would have that 100% equity, and we'd be able to own and operate it for the remaining 7 to 8 years.
Gotcha.
Obviously, all of the interest rates, the 500 basis
the debt markets definitely have changed.
Debt market explosion was the thing that few people expected, even though the writing was on the wall with inflation. But I think we're coming out of that, and there'll be opportunities now for rates to start to adjust again. The traditional model to get investors repaid is not necessarily through cash flow. It's through
a recap event.
A recap or a total sale.
Yeah.
You build something, you stabilize it, you sell it.
But obviously our goal is we want to retain these buildings, or we want to hold them and cash flow and keep them and hopefully pass them down to our children, because that's our long-term vision. We don't want, there are merchant builders out there that's all they do is they build, they stabilize, they sell. And that's a business model, and that's not really the model that we want to go after. So we realize now that, our investor pool probably might not have been the best fit for this specific type of property and that specific model that we want to go after.
Yeah, they may not have as long an investment.
And patience too,
Patience is a big thing, right? Because if you're getting a lot of small checks and you're like, people are writing you a check and it's a good chunk of their overall savings, they want that back at some point. Versus you're going out to a larger institution.
Makes sense.
Or a fund, and it's like nothing to them.
One more question about this whole debt situation. If there was anything you guys learned when it comes to the local lender you worked with, right? Obviously, you guys definitely have a track record, right, in being in real estate, but what else were they looking at? Are they still looking at credit scores even at that level?
They'll always run your credit for sure. Yeah, they'll always look at that. They look at past history and track record. Our particular scenario, we had a loan officer that actually knew us from a prior project, so he was actually a huge advocate for us. And they did.
Which we didn't know though. It was a funny story.
Yeah, we didn't know at the time, but we ended up finding that out afterwards.
Yeah.
But to that point, they said, well, what's the largest project you've done? And so we would talk about our projects, right? But we'd say, but what we're building is really, even though it's more units, total square footage, it's not much different. Yeah. And we're very competent in all of these practice areas, and there's just a few more that we have to jump into. And that was basically it. Plus, you have
the consultant,
you give away your firstborn. And
hiring the consultant was actually one of the things that they were really happy that we did, and they were. I think they were pushing it a little bit as well, because the consultant that we hired, had 40 plus years of experience. He had worked in some of the bigger shops, had his own shop for a while. So I think that obviously gave them a little bit of a level of comfort as well.
Yeah. No, so I talk about it, one, because we went through it with that project in Hyde Park, very similar story. You guys were lucky because you were like a year and a half before us, so the rates were lower, and we just couldn't make the numbers work with the higher interest. But
this project would not have worked at either in today's market.
And what I realized was, we went through the same exact experience where they were asking about, well, what's your experience? They were like, well, 3 to 6 unit building, and now we're talking about 34. So they wanted some type of consultant, somebody that really can be part of the team.
Yeah.
It looked to me like it was easier to get financing if the rates were right for a bigger project than the small ones sometimes.
If anything, that is a function of the debt broker making it happen.
Yeah.
So we ended up having 2 term sheets we had to consider.
Gotcha.
And we went with one where there was a unique offer to have the rate fixed during construction, which was a huge blessing in hindsight, to Dan's point, and to your point. Rates went up, and therefore if we were floating, which meant the rate going up as the Fed was raising rates, this thing would have debt service close to 2x what it was initially projected, and we'd probably be talking about a different experience at this point.
Altogether, yeah.
Well, the building would probably be up for sale right now.
Well, that's the different experience. Yeah, we'd be talking about a
To put it
fire sale.
bluntly.
If anyone wants to buy land,
Everyone's interested.
Because again, when you're going out to individual banks, they've got the leverage, right? Or you're just a potential customer. But when you've got a broker saying, hey, we just pitched this to the 30 banks in our network who wants in, every bank might be in a different position that they wouldn't disclose to us individually. They might say, well, we need to deploy money here, or this is an OZ deal, or this is, there's all different reasons why lenders lend.
So these were 30 all 1-bedroom units.
Mm-hmm.
Why just 1 bedroom and not 2 bedrooms or studios?
Yeah, so obviously when we were doing our initial massing study or initial concept of the building with our architect, we ran a number of different scenarios, and we had different combinations of unit type, unit size, how many 1-beds could we fit on a floor plate, how many 2-beds could we fit on a floor plate, how many variations of each could we fit on a floor plate. It was a pretty tight site. It was under 5,000 square feet.
4,000 change. 0 lot line.
Yeah, so it was a tight site, and to make the numbers work, we needed to cram as many units as we could on a floor plate. And so we modeled it out, and having all 1 bedroom, 6 units per floor, 5 floors of residential, that was the way the numbers would work best. And we did do a little bit of market research. We talked to some folks that have built and owned and operated some of the larger buildings in the downtown Lynn market, and they said that the 2 bedrooms were harder to rent than the 1 bedrooms in the studios, because especially during COVID and coming out of COVID, people didn't want to have roommates, and a lot of people were working from home and they wanted their own space. Yeah. So that's kind of how we moved towards the 1 bedroom model.
So, but I guess it's a combination just of what you can fit, but also you're looking at some rent numbers, right? What you can get from a 2 bedroom. Mm-hmm. And I guess, can you even find good tenants for a 2 bedroom versus 1? So you got to look at all of that to make the decision, right?
And then how much more square footage is a 2 bedroom going to add, and how many other units will you have to take away to fit a 2 bedroom on the floor plate? And so we might be able to get $500 more a month for a 2 bed, but if I have to get rid of 2 1-beds that can get me 20,
or even one
1-bed that can get me 2,100 just by adding another. So like the numbers just don't make sense in that scenario.
So having a good architect, obviously.
Doing a massing study during your due diligence.
Yes.
Because we actually had another property in Lynn under agreement months before this one came to fruition, and we had done a massing study, and some of our assumptions were wrong, mainly because that lot configuration required the building to be set back more. And so what we thought would be maybe 50 units ended up modeling out to like 30 something. And so that at that point we knew it wasn't feasible for our purposes.
Yeah, it's worth spending a couple bucks during due diligence to make sure that you can get exactly what you want on the site.
But then you also got to have the rent numbers really drilled down, right? Like you got to have either a really good leasing agent, right? Because that also is important.
Yeah, and
you guys went into Lynn, you did, right? That's,
I think residential leasing is a little more forgiving than condos, for example. It's important who you bring onto the team, of course, but I think everybody's looking for an apartment, and so it comes down more to your advertising and marketing strategy.
Lead flow.
Yeah, and having a team that can handle, if you're in prime leasing season, we were getting dozens of leads a week, so they've got to be able to filter through it.
Since we're talking about leasing, so let's go there next. What are some lessons learned there? Were you guys surprised at the numbers you are getting now versus what you had on the pro forma? What you started with to what you ended up with?
You can do the surprises, and I can talk about the numbers. We'll
sure. Where do you want to go first?
Take it away. Whatever.
I think lessons learned on the leasing side, we probably didn't understand the Lynn market as well as we should have. I think that we've had to decline a lot of applicants. I would say we're probably declining about 50% of all the applicants we're getting based on quality and history, income, credit, et cetera, et cetera. Yes. So I think that, we obviously want to put a good tenant in a brand new building and a quality tenant that we know is going to pay the rent. And so, we, I guess, are okay with taking a little bit more time to lease the building to make sure we get the right tenants. But we kind of underestimated how long that was going to take. I think there was some competition that popped up during construction. Some of the larger buildings in the area were sold and there was some turnover going on. So there were a lot more units that came online in the downtown Lynn market than we originally underwrote, or when we first started construction, there were way, way less. So that obviously was a little bit of a curveball. To Ray's point, I think hiring the right leasing team from the beginning was important. I think we kind of missed the mark on that, and we jumped the gun and chose a team that ultimately didn't work out, and had to subsequently bring in 2 more people. We're on our 3rd leasing team now, and so making sure that we have the right team in place on the next project, I think, is also very important. So those were definitely some of the lessons learned. And
yeah, in terms of numbers, we're a little bit below our projections. So we had some initial projections from the first leasing team in terms of where they'd be, and we're coming in above that blended average, but we're below where they thought we would be at this stage, because again, it's a 2-year full development cycle. So you're trying to project a couple years out, so you're putting a little higher number into your spreadsheet at the start. We're not coming in that much lower, to be honest. It's just slightly a hair below. But that's also due to some concessions, and an empty building doesn't pay the bills, and a building with slightly lower numbers, you can improve that in year 2. So coming to that realization as quickly as we can, and making that clear to the leasing team is probably something we would do next time as well. Like, you don't have to worry about, again, because we're not trying to flip the building once it's done. We don't have to worry about getting the highest rent and getting every bed filled. Right. We'd rather get, like Dan said, good quality tenants, have a good vibe in the building. And
create that community.
Right, yeah,
What do you guys look for in a tenant? When you say good quality tenant, what does it mean to
Well, it's tough, because
we're not meeting them.
I get it, but obviously you guys are making the final decision on it.
Right, so you're following all the fair housing. So we've got a mix of Section 8 and market rate tenants. But it really comes down to, I guess to Dan's point, were they honest on their application? I don't really deny people a lot, and we haven't had to until we got to this project. But people would just say they had none of any of the things that we look for. Right. And then I go out there and do some quick due diligence and find all those things.
You Google their name, and they come out on a bunch of news articles, and we're like,
Right. So without getting into all the specifics, just, are you submitting a truthful application? And do you actually have the income to back it up if you're, if you're a market rate tenant?
Three times the rent income versus
2.5. And we understand that moving is difficult, so we've also looked at different solutions for, instead of paying a security deposit, they have security deposit replacement policies. Or if a tenant is borderline, they could get rent, guarantor. So, it's just having that conversation. But to Dan's point, there's a lot of other operators that had 1 bedrooms, and I think one of them specifically was being very aggressive to fill their vacancies, even though their renewal rates were significantly higher than ours. So, at the end of the day, I think what will matter is the year one experience, translating to good reviews if we can get some online, and keeping the tenants happy and showing them, you're not just paying rent to live there, you're getting a responsive operator. And
that's huge. That makes a lot of difference.
It's all about the experience.
Right.
And making sure that they're tended to.
Yeah.
And you can kind of tell, right? If you ask for a little more information, like for example, if they have a pet, well, I know that they need to have a rabies vaccine, and you have to make sure they're not a certain breed for insurance purposes. So if they're responsive and getting back to you, they're going to treat the place well in theory.
And continuously asking for feedback, I think, is important too, right? We like to reach out to tenants and ask how they're doing and what can be improved, and what they like, what they don't like, so that way we can adapt and we can change things in real time as we get and collect feedback, because I think it's important, we're trying to create like a boutique type living experience. And so, in order to do that, we just need to make sure that we are living up to what their expectations of us are, because we obviously have expectations of how they should treat the building, but it goes both ways.
Are you guys managing in-house as well? Property management in-house?
Yeah. We do have a remote VA. So she's been very helpful getting the initial word out and being sort of our tenant liaison. Nice. And to Dan's point, we've drafted up a number of templates, and from an operational standpoint, we're there to try and make sure they have all the information they need and make sure the move-in process goes well. Access is where it needs to be. It's provided the day it needs to be. We're using remote access system, so that's gone really well. Just making sure that it operates and functions like a regular building, and
setting up those systems to kind of hand it over to the VA to be able to execute also requires obviously a little bit of upfront time and tweaking and things like that, because obviously operating, and Ray's more on the operational side than I am, but operating a 30-unit building is obviously very different than operating a 3-unit building. And so there's a much different process and procedure that has to go into that.
What number of units are you guys up to? So with a 30-unit now,
we're just over 50. So, it's not like we're moguls.
You're talking about in our portfolio?
Yeah. So this building actually doubled our portfolio. So was it a lot to take on? The biggest change is just having somebody. We did have a remote VA before, but no set hours. So I noticed that the service was slipping. Now we have somebody 4 hours a day, every day of the week. And if there's any escalations, we also have a call center that is specific to real estate. So they actually have like our triage spreadsheet for each property, for each contractor, since some contractors are North Shore, South Shore. Right. So every tab does the property, and then who's to contact. So if somebody does call in and has an issue, they have their own internal matrix of how to fix things, and maybe self-help. Oh, toilet won't flush, jiggle the knob, or, pop off the lid, see if you can see anything, versus just sending a plumber out blindly, where we've seen with other management companies, when you have a third party managing it, they just dispatch somebody, and you're getting a bill before you even know if it's a real issue.
So you guys have created layers pretty much before it gets to you. It's either,
of course, yeah, we're the escalation. Yeah. If it's we hope it doesn't get there, but stuff always happens, whether it's just an urgent issue in general, or for some reason expectations weren't met.
At what point do you bring somebody full time for property management? Is there a number of units or revenue? Or
it sounds like a lot of units, but interestingly enough, there's not a lot of day-to-day to-dos. Okay. The older buildings have a lot. And so, again, this is a reason why we wanted a newer building. We built it all. And during the final CO process, Dan and I went through and tested everything, touched every doorknob and drawer, and made sure things were working. And yeah, we had a number of things that had to be adjusted in punch list items. Yeah. We dealt with that before tenants moved in. We didn't want them to have a bad experience.
There's obviously a break-in period in any building or any renovation that you do, even whether it's condos or rentals, right? Yeah. Like you have a 1-year warranty on a condo project, and that something is going to happen during that year. Something's going to break. Nothing ever
You're not living in it during construction. There's just no, how am I going to live in 30
Once you start
units?
turning things on and running things, and it's just the nature of the beast, right?
Yeah.
But I don't know. You were going to say, how many units do you think we need in order to hire someone full time?
He's avoiding the
Full-time?
He's avoiding the question.
Well, no, I think honestly, I think we could probably go full time with 75.
Yeah.
75 is probably 75 to 100, depending on the skill of the
Because all of our
manager.
buildings pay the property management company every month, right? There's a percentage of the gross rents that flow through to the property management company, and once that gets to the point where it's like a full-time salary, then we
Right,
bring
if
someone
you
on.
bring in $1 million and you got a 7%.
Exactly.
Property
It's
management,
win-win
right?
because we can charge all of our property entities. It's everything separate LLCs. Our management entity charges all the properties, so it's kind of paying itself and making a little bit of money. But we're also keeping the costs low on each property's basis. So it's kind of win-win there. I think, it also depends on the tenants, and Section 8 tenants just have a ton of paperwork with the housing authorities. Yeah. So if you had 75 Section 8 units, maybe you would need 2 people just because there's so much paperwork and coordination. Versus, a market rate tenant, they see it, they like it, there's no inspection. And
I also think it
contracts.
also depends on the geographic location of where your properties are, because we have, a number of properties we have are in Dorchester, but then we have kind of a random property in Bridgewater, and now we have the property in Lynn. So, it's kind of spread out, and then, we're starting to look at some other projects or potential projects in southern New Hampshire. So it's like, that's a pretty large geographic area. So I just don't know if having a full-time, property manager could even handle driving all over the place.
Yeah.
right. You still have to have somebody on the ground.
Like local. Yeah. But that's kind of, I guess, TBD, and that will kind of work itself out as we continue to grow, I guess.
Well, there's a way around it, and not to keep talking about it, but if you have a couple handymen, they can do your inspections, they can do your turnover repairs. You get a painter in there. So really, what it comes down to is the access. And one of my goals for next year is, because the access control system has been going so well for us here, go keyless in all the buildings, because the keys are dead. And I'm tired of, no offense to locksmiths, I'm tired of making key copies. Right. And then the tenants make copies and they send it to somebody else. Once your lease is up, your access is done. And that's really nice, because now you don't have to worry about chasing those down. And the new tenants moving in don't have to worry about can they get back into the building? So that's another area. And that would just make dealing with the whole turnover and management process easier, because that's one of the biggest things is like, go check it out. We'll make sure they're out. And so
that's awesome. So we have to wrap it up, obviously, to head to the room and network. But how do you guys exit this project? Like, what does that look like with the current lenders, right? As far as a refinance, what does that? Obviously, there got to be a way there to pay them back. Mm-hmm. Obviously, I know you want to carry the building for as long as possible, but just curious, how do you exit a building like this? If at all.
I mean, we've been talking. That's what we've been talking about. Is our strategy.
That's now that we're done and we're in the lease up phase and stabilization phase. Obviously, Ray and I have been having a number of conversations about that over the last few months.
I mean, we have no interest in touching the senior debt, which is at extremely favorable terms in today's market. Yeah. So the other options are either getting rid of other assets in the portfolio and using those proceeds to take out the investors. Selling the asset, or getting like a bridge loan or additional debt or equity to take out the initial investors. So maybe you do have to bring somebody on that wants a piece of the equity, but if they're going to write one big check, take everybody out, and they have a long vision and they're looking to invest funds for a while, maybe that's win-win for everybody.
The good news is that our current investor pool, they have a 5-year term. Okay. on their note, right? So we do have some time. Obviously, the initial conversations we had with them was, our goal is to get you paid back within 2 to 3 years. And so, we haven't even entered that 3rd year yet. So I think, the other option is, let's see what happens to the debt market over the next 6+ months, and maybe mid 2025 we can look at a recap event. And if we do go through 1 year of leasing cycle and we can raise the rents and increase our NOI, then obviously the overall value of the building increases. So maybe we can pull more out to repay the investors. So there's a lot of, and then as debt markets maybe, relax a little bit, then cap rates also relax a little bit and values go up, and then maybe there's more interested buyers potentially. But we have that OZ component, and so unless we get a number that we can't really refuse, we really want to try to hold on to the property for that 10-year period to capture that OZ potential tax incentive, right? So kind of a lot of balls in the air, I guess. The good news is like to Ray's point, we're in a good place where, we've talked to a number of folks in the debt markets and stuff like that, and they were like, everyone told us you're in a really good position, you should stay put, wait it out longer, give it a little time, because we don't want, we're not forced to do anything where we are, which is a good thing, because there's huge. Other folks that are not in that situation. So, so we are lucky in that regard.
And there's really, from the investors, from the limited partner standpoint, they're not adversely affected. Their return isn't affected or go down or anything like that based on the performance. It's really a duration type event. Yeah. Think of it as like preferred equity. Preferred debt. So their interest is accruing, or has been accruing. Yeah. So, I mean, obviously, selfishly, Ray and I would like to get paid too at some point. So it's like, I'm not, let's not beat around the bush, right? Right. The structure of the entity is such that we don't even get paid until the investors are all out. So there's obviously motivation for us to find a solution. And there's a lot of different options, and sometimes you just have to be patient and wait, especially with what we've just gone through. So I think everyone is way more optimistic as we go into 25. Survive till 25 was the motto in 23 and 24. Yeah. And it's fine. The building's cash flowing enough to support itself. It's really just a matter of time.
Once you are fully leased, will this building cash flow?
Oh yeah.
Yeah.
Yep.
Yeah. Gotcha. That's awesome. Partnerships. How do you get a partnership like this to work out?
You had a really good answer.
2010.
No, Dan had a really good answer.
That's 14 years of working together.
Yeah, he had a really good answer, and it was about starting at the same time, same place.
Yeah. So I think partnerships, in my opinion, partnerships work the best. Well, I think there's a couple of things. I think everyone has strengths and weaknesses, and recognizing what those strengths and weaknesses are, and not trying to step on the other person's strengths, I think is important. But I think also when you're looking for a partner, or you're looking to form a partnership, I think going into starting something and you're both at the same starting point is very important. I had my triple decker, but other than that, we had nothing. We had no assets. We both had full-time W-2 jobs at the same company. I feel that where things get hairy and don't work out is when one person is bringing a lot more to the table than the other person, and then there could be it doesn't feel fair. There could be animosity and resentment and things like that. But Ray and I started this from pretty much nothing.
We threw everything together. Yeah. We threw it all on the line, right? We risked all of our money.
We both
credit.
Yeah. We both took out tons of credit card debt. We both liquidated our 401ks for the first project. We both went all in together at the same time. So we both had just as much to lose. And so when that's equal, I feel that there's a lot more potential for success.
And personally, we've kind of grown in that we're on the same track. We both kind of got married and had kids around the same time.
Both the same age, both in the same points in our life. So we were kind of able to experience that together.
But to Dan's point, learning early on what didn't work was helpful, and having open discussions about it, right? Why are we getting so mad at each other? It's we're both on site each day. We don't need to be on site. Mm-hmm. It's why don't you focus on this? That's what you're good at. I'll focus on this. And literally that was all it took to fix, I wouldn't even call it a problem. It was just unnecessary redundant activity.
Yeah. It's to be more efficient with your time. Right? It's
seriously.
That's what it is. I spend more time on the phone with Ray than I do with my wife, right? So it's it's a marriage, and it's important, and obviously there's bumps in any relationship, and so just making sure that you're open and honest with the person. That's, I think, the most important thing.
So what's next for HR Investment Group? What does 2025 look like? What's in the plans? What are you working on?
We're currently seeking. We're seeking projects, but we're also
right there.
Yeah,
So tell these people so they can reach out.
But we are also in the next phase of our RH Investment Group, umbrella, which is a brokerage. So Dan can speak to our brokerage efforts that we're looking to start and expand on to bring more things in-house.
Yeah, so in addition to obviously growing the rental portfolio and increasing the overall number of units that we own, which we've been looking at for the past couple months, we started a brokerage, an in-house brokerage that we're going to be launching or are launching and looking for agents to join. So if anyone is interested, feel free to reach out, Dan at rhinvestgroup.com. We wanted to start the brokerage to create a fully vertically integrated business, right? So
Makes sense.
we want to be able to control an asset from acquisition all the way to disposition.
Keep it all in-house.
And by starting the brokerage, I think that was we already have the development side, we have the kind of asset management, property management side. And so the brokerage was kind of the final piece to the puzzle.
Where would you guys focus? What that brokerage, would that be all of Boston, North Shore, Greater Boston?
Really depends. I don't think we're really set on a geographic location. I think that we're willing to bring in any agents that really want to just learn to grow. I think there's a good opportunity here, and we can offer some experience on the development side and the investing side that I think other brokerages won't be able to offer if agents do join. I think that if people want to learn about new construction, development, if they want to pitch developers on selling their projects, Ray and I can obviously help in terms of running numbers, in terms of underwriting deals and things like that. And then if agents are interested in investing themselves and buying multifamily or starting their own portfolio, then we want to help them grow as well. So I think it could be a unique opportunity for agents that obviously want to grow their book of business, but also learn the development and investing side.
That's awesome. Do you have any projects under contract right now in the multifamily space, or?
Nothing right now.
Yeah, so to answer that initial question, no, nothing right now, but Dan's been filtering things out, and we've been having discussions as it gets into the sort of secondary phase of analysis that there's always options, but it comes down to
it's been hard to get things to pencil.
What works, what doesn't from an owner standpoint. Yeah. I think another one of our goals also is to perhaps take ourselves out of a secondary or tertiary market and kind of move into a different market that maybe there's not as many challenges on the leasing or sales side from a
Southern New Hampshire or something else.
Not necessarily Southern New Hampshire. It might just be a different market. Now that we've gotten out of Lynn and been more comfortable with it, now we can expand our search area.
We're open to Southern New Hampshire. I think in terms of tertiary markets, he means like a little bit more of an established market. Okay. Where we don't have to reject 50% of our tenants. Yeah.
And maybe perhaps looking from, where new construction may not work right now because, properties are trading sort of below their replacement cost due to that higher debt, maybe getting back into the value add on an existing property type analysis. So we've sort of been looking at both, but the numbers seem to be gravitating towards existing housing stock and improving it rather than necessarily building ground up. But again, that's also, to Dan's point, market dependent where the numbers will be.
Other than the email, anywhere else, where can people go to visit you guys or learn more about you? Or
Yeah, we're on social media, RH Invest Group on Instagram. rhinvestgroup.com is our website.
That's awesome. This is great. I love having you guys, love having a conversation because you guys are open to sharing the good and the bad, really authentic and transparent. And it's hard to find people in our market that's willing to share and not look at each other as competitors. So I appreciate you guys a lot. We got to head back and network. And all you guys watching, like, share, subscribe. Definitely follow these two guys because they're up to big things. Catch you on the next one. Thank you.
Thanks, Enis.
Thanks for having us.
Yeah, thank you so much.
This is great. Yeah.
Cool, man.
All right.
That's it. It's a wrap.
That's it. It's a wrap.